All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Tuesday, everybody. Today is June 10th, 2025. Top story this morning is the UK unemployment rate. Now, that might seem like kind of a specific data point, and I think a lot of people probably, it's hard to get excited over the UK unemployment rate if you're not in the UK. But this follows what we got last week here stateside in the non-farm payrolls. And to this day, it's been a couple of days now, I'm still amazed at how wrong coverage in Western media was of that jobs report. The jobs report on Friday here in the States was terrible, especially if you consider the downward revisions to previous months that virtually wiped out all of the jobs that were gained for the month of May. And then this morning, we got labor data in the UK, and it was every bit as bad as what we saw in the States, actually a little bit worse. Let's talk a little bit about specifics. The unemployment rate in the UK rose to 4.6%. That is the highest it's been in 4 years, nearly 4 years, since August of 2021 was the last time unemployment was this high in the UK. And in August of 2021, that was when we were still on the downslope, the recovery from the vid when unemployment exploded higher. So really, this is the worst unemployment we've seen since COVID. Really bad data here. We've also got wage growth is slowing. We've got HMRC payrolls. That's a separate data point that came out in the UK. That stands for Her Majesty's Revenue and Customs. I guess that's like their IRS that counts public payroll data. That showed job losses of 109,000 in May. The UK is not that big. That economy can't easily absorb 109,000 job losses. On top of that, they're also playing the United States' favorite game of downward revisions to prior months' data, because April's jobs numbers for HMRC payrolls, those were revised lower from 33,000 jobs lost to 55,000 jobs lost. So in total, the UK lost 131,000 jobs last month. The labor data is very weak. Now, what happened in the UK? You've had a couple of things. You got a big tax hike that the Labor government just passed. Higher payroll taxes makes it more expensive to employ people. They also passed a minimum wage increase, which is just talk about shooting yourself in the foot. It's not very politically apropos, but look, guys, minimum wage increases economically are just stupid. No, I'm not against poor people making more money. Not at all. I want poor people to make more money. It's one of the reasons why I'm always talking about how I wish the central banks would just stop printing the crap, because it makes it harder for poor people. But minimum wage increases is nothing more than a ban on work for people whose skill set falls below that threshold. When you raise the minimum wage, employers don't suddenly pay more than a person's skill set is worth. Now, they may have employed people who have a low value skill set because they're allowed to pay them a value commensurate with that skill set. But when you artificially raise that price, the employer is going to say, if I only get $4 worth of economic activity out of this person, I'm not going to pay them $5. I'm going to fire them or lay them off if you make me pay them $5. And so ultimately, it's a ban on work for people with low value skill sets. And who is a minimum wage hike supposed to help? It's meant to help people with low value skill sets. So in other words, minimum wage increases are counterproductive. They most hurt the people they're supposed to be helping. You cannot eat good intentions no matter how hard you try. Now, on top of the higher payroll taxes, on top of the increase in the minimum wage, we've also had tariffs, which certainly not helping the employment situation in the UK, even though we've stepped way back from the tariff threshold and the 145% tariffs we were putting on China. They lowered the tariffs to 10% in the UK. That is still going to hit UK employment. And so those three things combined just caused a mess in the UK's payrolls. Guys, it's not much better here in the States. And I talked about this all Friday. I could not believe how everybody was saying how this was such a good jobs number here in the States, just because the headline number of jobs added was a little bit higher than what the market was expecting. But the market didn't account for the massive reduction in payrolls from previous months. The labor market is weakening. It is not just a UK trend or a US trend. This is globally. It's happening in Asia. It's happening in Japan. It's happening here. Labor markets are a mess. Now, also going on this morning, we've got Apple's Worldwide Developer Conference got underway yesterday, and it was kind of underwhelming. Apple announced their big announcement was liquid glass, which if somebody wants to tell me what liquid glass even means, I'd love to hear it. I think it sounds a lot fancier when you have somebody use a phony British accent when they're describing liquid glass. For example, liquid glass, that's me and my gringo pronunciation, but liquid glass, does that not sound more refined and fancier if you called it liquid glass? See how all of a sudden it sounds more techie and more innovative? It's a simple user interface redesign, a slight change to the graphics. The menus are slightly transparent. Now, honestly, I don't know what the heck the point of liquid glass was, but the market yawned and Apple stock dropped on that news. It wasn't a huge drop, but the market was hoping for some kind of AI announcement from Apple. Personally, I don't see the big deal. Apple is the one company that has not mindlessly burned hundreds of billions of dollars in CapEx just because AI, like throw money at the problem and hope for profit later. Apple's the one company that hasn't done that. And I think in the long run, they're going to actually be better for it. I could be wrong about that. But for now, the market wanted to hear something about AI or Apple Intelligence, and they just didn't. And so they were hoping to be overwhelmed. I guess nobody really thought they were going to be overwhelmed by Apple's announcement, but they were very much underwhelmed when I guess they were kind of hoping to be just whelmed. We were not whelmed. That's certainly the case. So Apple continues to struggle to innovate after several years of this. There were some updates to iPad software that's going to allow multitasking. That might drive a little bit of a bump in iPad sales, making those more productive. But outside of that, it was kind of a non-event. Also, we've got a big development yesterday, or at least I heard about it yesterday. I think the story's a few days old, but a shout out to my friends over at Macro Edge who caught this one yesterday. There was a huge announcement at Amazon Web Services. Nobody in the legacy press covered it. You have to go to some very specific trade websites to see it. But AWS just cut their prices for a certain cloud service that, let's just say there's a lot of companies that are going to have to write down a lot of money worth of hardware because of what AWS just did. And a company that I just love to talk about, you can probably guess which company, is in big trouble if this situation at AWS translates to what's going on elsewhere in the cloud. You're not going to want to miss this one. And why is nobody talking about it? Probably because it doesn't jibe with the narrative of insane demand. On top of that, you got U.S. and China trade talks are ongoing in London for their second day. We're not hearing a lot about what's going on in those trade talks. So really, you're just left with people's pre-existing political dispositions, great, big, beautiful trade talks on one side, and, oh my God, Mr. Orange, bad on the other side. Nobody really knows what's being said there. We've got Rolls-Royce is building the UK's first small modular reactor. That announcement came yesterday. We've got Paramount is laying off even more employees, and Japan is dumping more rice from its strategic reserves. What the heck is going on with food prices in Japan? The price of rice has more than doubled. We talked last week about how they were dumping rice from the strategic reserve. They're dumping another 200,000 tons today, flooding the market with rice to try to keep the prices from rising. And it's only the primary staple of the entire population. I'm sure everything is just fine. Good luck with your virtuous cycle of inflation over in this Keynesian wonderland that is Japan. We got a lot to talk about this morning. How about we shrink my big melon of a head and let's see what's happening in markets. And by the way, this is the point where I say, please hit that like button. And if you're new here, hit that subscribe button because we do this every morning. So come on back and have your coffee with the melon heads as we go through markets. And right now, the S&P 500 is just barely positive for the day, up 8 points or 0.13% ahead of the open. The Dow is up by 12 points or 0.03% ahead of the open. And the NASDAQ is up by 35 points or 0.17%. So look, stocks are positive, but barely. So, I went with the bull for the thumbnail this morning because the indexes were just barely positive. If they're red, if 2 out of the 3, I go with the bear. But really, the market is just flat, and there's not really an animal for a flat market. There's no platypus that we could use to describe what's happening in markets right now. But yeah, modestly positive, so we get the bull. Meanwhile, the DXY is lower this morning by 11 basis points, 98.90, back below that 99 threshold. The dollar continues to weaken. Looking over at the bond market, we got yields are a little bit lower on the long end, so we got a little bit of buying going on in bonds this morning. The 30-year Treasury, 4.915. That's lower by almost 4 basis points. The 10 years at 4.447. That's off by 3.5 points. The 2 years at 3.989, lower by almost 1.5 points. And the 1 month is at 4.251, up by just a fraction of 1 point. Looking over at the commodities board, we have got spot gold is higher once again this morning. That's up by $14, $3,340. That's about 0.4% higher. Silver, meanwhile, is taken a little bit of a breather. Monster day for silver yesterday. Now, as of now, it's down about a nickel or $36.70 for spot silver. That's lower by 0.15%. The front month silver contract is actually higher by a couple of pennies. So really, silver is just pretty much trading flat here. Very briefly yesterday, that front month July silver contract actually peaked above $37. Blink and you missed it, but it was for just a little time. So silver continues to perform very well here, despite a little bit of red this morning. And I don't know if I told you guys this, but I like the shiny. Copper, meanwhile, lower by about 0.3%. Platinum is up another percent here, $1,225 for July platinum futures. Palladium is lower by about 0.9%. And crude oil continuing to grind higher here, another 0.3% higher, 65.47 for July WTI crude futures. That's higher by about 17 cents. And speaking of commodities and gold, I saw an interesting article in Market Watch here. Gold and the S&P 500 are chasing record highs at the same time. Here's why that's so rare. Now, Market Watch is going to great lengths here, and they're tiptoeing around what's really going on. But let's just read a little bit of this. The S&P 500 and gold are both within striking distance of all-time highs, a rare event that leaves investors wondering what exactly is going on. After all, stocks at all-time highs indicate that investors are optimistic about the future and happy to pile into risky assets. Gold, meanwhile, is often viewed as a safe haven, a port in the storm during periods of uncertainty. It's like watching someone eat salad and dessert at the same time, said Adam Coos, president and senior financial advisor at Libertas Wealth Management Group. Investors are trying to be healthy, but still hedging against what might come later. It is possible for both the S&P and gold to hit and hold record highs at the same time, but it's not exactly the norm, he said. When it does happen, it's usually under a specific set of conditions that reflect a combination of optimism and anxiety in markets. And a whole bunch of gobbledygook later, they actually tell us what's really happening in this paragraph. The rare positive correlation between gold and the index, which historically tend not to peak together, may have been fueled by dovish Fed expectations and fiscal as well as structural concerns, said Dina Ting, head of global index portfolio management at Franklin Templeton. And that's, again, a lot of gobbledygook there, but we've got dovish Fed expectations. In other words, money printing, lower interest rates, fiscal as well as structural concerns, runaway government spending, borrowing, stress in the bond market. That is why we're seeing stocks and gold hit all-time highs at the same time. This is monetary debasement. They don't want to say that here in this Market Watch article. They don't want to say the reason gold and the S&P 500 are both flirting with all-time highs is because our leaders, both monetary and fiscal, have their heads so far up their collective derrieres that they can, I don't know, I didn't really think over this metaphor ahead of time, but they really suck at what they're doing, and they are debasing the currency. That's why gold and stocks are rallying in tandem. We're watching the debasement of the denominator. We're not watching the numerators improve. Elsewhere, we've got Bitcoin, $109,845 this morning. Now, it's showing a little bit of red here, technically down a little bit from yesterday, but Bitcoin had a fantastic day yesterday. The day started, we were priced around 105,000. We went as high as $110,651 yesterday. We're slightly off those levels here, down by a couple of $100, $109,847. But Bitcoin also flirting with all-time highs, along with gold, along with stocks. Again, we're watching the currency get less valuable. We're not watching everything else go up in value. All right, let's talk about what's happening in the UK here. The United Kingdom's unemployment rate edged up to 4.6% for the 3 months ended April 2025 from 4.5% in the previous period, matching market expectations. When the UK reports unemployment, they report 3-month moving averages. So this is the data as of the end of April for the prior 3 months. This marked the highest level since 3 months ended August of 2021, attributing to moderating wage growth following sharp increases in payroll taxes and a 6.7% rise in the minimum wage. Go figure, higher taxes and minimum wage hikes lead to higher unemployment. Say it ain't so. Price controls don't work, and minimum wage increases are price controls. The number of people unemployed for up to 6 months increased, as did those unemployed for over 12 months. On an annual basis, unemployment rose for both those unemployed up to 12 months and those unemployed for over 12 months. Meanwhile, the number of employed individuals rose by 89,000 to 34.01 million, marking the smallest increase in employment so far this year. Put a pin in that. We'll circle back to that with another data point. But gains were driven by higher numbers of both part-time and full-time workers. The number of people holding second jobs also rose. That's something we've seen here in the States, now accounting for 4% of all employed individual. An economic inactivity rate decreased by 0.2 percentage points to 21.3. I'm not really familiar with the economic inactivity rate. I'm not sure what they're saying. It seems like a double negative. But here you can see the unemployment rate clearly rising, not an alarming rate of increase, but a slow grind higher. Now, to really get a good idea what's going on here, let's look at 5-year charts. Now you can kind of see how the unemployment rate in the UK is steadily grinding higher here. And again, we are the highest since August of 2021 was the last time we hit 4.6%. And that was during the downslope coming out of COVID. So not exactly a like-for-like comparison. And if we zoom out even more, you can see here we did have declining unemployment throughout all the 2010s during the period of Zerpenber. And now that is rising. Get ready for higher unemployment rates along with those higher interest rates, folks. Now, we also got the HMRC payrolls change, Her Majesty's Revenue and Customs. This is counting the number of people that are on the payrolls according to the UK's tax collectors, which sounds like a pretty good measure. The number of payrolled employees in the United Kingdom declined by 109,000 or 0.4% to 30.2 million in May of 2025. That's following a downwardly revised 55,000 decrease in the previous month. This marked the 7th consecutive monthly decline and the sharpest fall since May of 2020 as the labor market deteriorated following big increases in payroll taxes and the national minimum wage. Compared to the same month last year, payrolled employment fell by 0.9% or 274,000, with the biggest drop seen in accommodation and food service activities. Here you can see the monthly change in the number of payrolled people. Again, several months in a row, we've seen these declines. And again, if we look at a 5-year chart here, you can see this is the worst number. It's actually accelerating to the downside, the worst number since 2020. What did they say? I think May of 2020, which was pretty much like the COVID's worst. The worst of the COVID was in April of 2020, which was 444,000 or 443,000. So if you take this is bad, guys. The only data point worse than this month for payrolls in the UK was the peak of COVID hysteria. That is awful. And by the way, while all this is happening, while unemployment is rising, the situation where the Keynesians tell us should be impossible, we've actually got inflation rising along with it. Now, the Phillips curve tells me if inflation is rising, unemployment should be going down. But then again, you have to remember that Phillips is wrong and the Keynesians are wrong, and that it's not necessarily inversely proportional, although sometimes it behaves that way. You actually can get rising unemployment and rising inflation at the same time, a situation that is not the textbook definition, but sometimes referred to as stagflation. And we're seeing that set in more and more places. We're seeing the word stagflation creep into the vocabulary in central bankers and Wall Street and the financial press here in the States. We're seeing it in Europe, certainly overseas. So, yeah, things not looking so good in the UK right now. And again, not looking so good here in the States either, even though gold and Bitcoin and stocks all chasing all-time highs. All right, let's talk about what's going on in Apple. Meanwhile, Apple's AI takes a backseat to design and the iPad revamp at WWDC event. It was kind of a yawner yesterday for Apple. Apple unveiled the most sweeping software redesign in its history, aiming to make the company's device lineup more cohesive and useful, even while doing little to upgrade its struggling artificial intelligence platform. They're really trying to make this story sound interesting at Bloomberg here. The new interface called Liquid Glass or Liquid Gloss was introduced Monday at Apple's annual WWDC conference. The approach uses transparent menus and a glossy look, transforming the software on the company's iPhone, iPad, Mac, TV platform, smartwatches, and Vision Pro headset. I'm glad that we're including the Vision Pro there. I mean, we sold tens of those things. Look, transparent menus, all right? This is the biggest innovation since emojis. I mean, I really don't know what Apple is hoping to accomplish with this. It's neat. Some people are going to like it. Some people won't, but I don't really see the reason to spend all the money on a conference to announce this. Monday's event held few surprises, with Bloomberg News reporting on all the major changes prior to the presentation, and investors were unimpressed. Shares fell 1.2% at the close in New York after being up earlier in the session. Apple has now lost 20% of its value this year, costing the company its crown as the world's most valuable business. But even if WWDC lacked major twists, it still delivered news that many Apple fans have been seeking. That included the iPad software upgrade, which adds computer-like multitasking, a PDF document manager, and other ways to better handle files. The changes are expected to help make users more productive and turn the iPad into a more effective tool for office work. And the iPhone received a revamped phone app that integrates voicemails, recent calls, and favorite contacts into one view. And the Vision Pro headset will get the ability to pin digital widgets like a clock or a stock ticker on a wall. Big hopes for that Vision Pro. Any day now, those sales just going to explode higher. Apple yesterday down 1.21%. It's down a fraction of a percent this morning, $201.25. Basically a non-event for Apple shareholders yesterday, which was largely expected. That's the one silver lining there, is nobody really expected any big innovation from Apple, although I'm not sure that's a good thing. Now, here's the big story that nobody is talking about. And again, shout out to my friends over at Macro Edge who caught this one yesterday. This was flying below the radar. On June 9th, AWS cuts costs for H100, H200, and A100 instances by up to 45%. All right, AWS, that's Amazon Web Services. If you don't know, that is the largest cloud provider in the world. And they are cutting the cost of NVIDIA GPU rental virtually in half. How is this not front page freaking news, considering how much money big tech, along with neo clouds like CoreWeave, spent on H100 and H200 GPUs over the last 2 years? The fact that the revenue those things are generating just got cut in half, and they're not covering this? This didn't even get mentioned in CNBC and Bloomberg. Oh, we wouldn't want to interfere with your insane demand hypothesis about how, just buy more GPUs, phase 3 profit. Wow, this is huge news here. Amazon Web Services has significantly reduced costs for accessing NVIDIA's H100 and A100 GPUs on its platform, revealed by the company on June 5th. All right, this is a 5-day-old story, and we're just hearing about it now. The price reductions have applied to on-demand purchases since June 1st and to savings plan purchases after June 1st. The instances impacted are for the PD4, A100. Okay, they're naming all these acronyms for these specific GPUs. The on-demand price reduction is 33% for A100s across both instance types, 25% for H200 instance types, and 44% for the H100. And the savings plan cost reduction varied from 25% in 3 years to 45% in 3 years. Now, a year ago or so, H100 was maybe $5 to $6 per hour. This is a year ago. Now it's around 75 cents, maybe less. Hardware typically depreciates in 3 to 5 years, but that's happening in 1 year now, Brettel told Data Center Dynamics, though he noted that this was more of an issue for neoclouds who have a one-to-one relationship between the rental property and the customer. All right. So they're saying this isn't such a big deal for AWS. They've got other businesses and things going on. But neoclouds, and there is one particular name when you hear neoclouds, that is CoreWeave, folks. CoreWeave is basically a massive pile of debt right next to a massive pile of GPUs. And we're hoping one gets to zero before the other, depending on your outlook on the stock. That's basically that company summarized. And the revenue those H100s are generating just went from $5 per hour last year to 75 cents. Now, these things are supposedly going to last for 6 years. CoreWeave says we have a 6-year depreciation schedule. And after that, we own them scot-free and we can generate all that revenue and it's all profit after that. Well, what happened? What does this trend look like over time? If you're CoreWeave and you borrowed $10 billion to buy H100s, this story is a death sentence. And worse yet, if you lent money to CoreWeave collateralized by these H100 GPUs, oh boy. Oh boy. But hey, it's not like anybody tried to warn about this thing, right? It's not like anybody warned, say, in August of 2023 or September of 2023 that electronic circuits don't hold their value over time. They're rapidly depreciating assets. Well, here it is, folks. Brettel explained, let's say your leasing cost is fixed over 3 years or even 5 years, but if your revenue is eroded by 80% in just 12 months, then you have a real problem. In the case of AWS, the reduction of pricing is unlikely to hurt its business in the same way because AWS is part of Amazon. They can absorb that. They're a much bigger company. But even still, how many billions has AWS spent on these GPUs over the last few years? There is a massive write-down of the value of those GPUs coming, and that's going to come right out of Amazon's earnings. Same thing's going to happen to Meta. Same thing's going to happen to Microsoft. Same thing's going to happen to Tesla. The depreciation expenses that big tech is in for are going to be so massive, and they're all going to admit it at the same time. It's going to hit like a ton of bricks, and of course, it's going to wipe out CoreWeave. They will be absolutely wiped out by this. This company, CoreWeave, is a zero long-term. Bank on it. I don't care what the short squeeze does in the short term. Maybe the squeeze is higher. It's not a function of the underlying business. It's just a function of market mechanics, and it's Magnetar playing games with the issuance. This company is a zero long-term. Meanwhile, speaking of GPUs getting written down and neoclouds losing revenue because of it, let's also remember that the cloud customers are all getting sued because they're stealing intellectual property. We talked about this yesterday. Here's another one. Reddit brands Anthropic as anything but a white knight, heating up AI scraping wars. Another big lawsuit over IP theft by AI companies. A clash between established online content providers and AI upstarts is heating up again as AI-driven large language models gobble information in a race to dominate the web's frontier. The latest of the scraping wars is between Reddit and AI startup Anthropic, a company backed by tech giants Amazon and Google that created the AI language model Claude. Reddit is claiming in a new lawsuit that Anthropic intentionally scraped Reddit users' personal data without their consent and then put their data to work training Claude. It's not really the without their consent thing. It's that they scraped the data without paying Reddit for it. That's the thing. This isn't so much about Reddit users' consent as much as it is Reddit capitalizing on Reddit users' consent, but I digress. Anthropic is also defending itself against a separate suit from music publishers, including Universal Music Group, ABKCO, and Concord, alleging that Anthropic infringed on copyrights for Beyonce and the Rolling Stones and other artists as it trained Claude on lyrics to more than 500 songs. The confrontation between Reddit and Anthropic adds to a growing number of high-profile cases where copyright holders have tried to guard their works from the reach of tech firms. A question at the heart of these lawsuits: can artificial intelligence companies use copyrighted material to train generative AI models without asking the owner of the data for permission? In other words, does intellectual property exist or not? Courts haven't settled on the answer. However, last February, the U.S. District Court for Delaware handed copyright holder Thomson Reuters a win in a case that could impact what data training models can legally collect. Though the problems in AI continue to mount, but you know what? Demand is insane. Just keep aimlessly bidding up stocks. Never mind the fact that the companies are stealing, and if they're not allowed to steal, they can't pay their bills. If they can't pay their bills, the companies buying the GPUs can't service their debt, and the whole bubble go poof. Meanwhile, China and the U.S. is holding a second day of trade talks in London. Look, guys, there's not a lot to report here. There's basically nothing to report about trade talks other than the fact that the trade talks are happening. They're being very tight-lipped. You can interpret this any way. Maybe they're not saying anything because they're not going well. They don't want to spook markets, or maybe they're not saying anything because they're going so well that they're going to have this big, beautiful announcement and everybody's going to sing Kumbaya. I don't know. They're not telling us. So until we hear something, we have got Schrodinger's trade talks are happening in London. Meanwhile, aerospace giant Rolls-Royce is building Britain's first small modular nuclear reactors. Not a lot going on here or to this story other than the fact that Rolls-Royce was chosen for the model here. I'll just read you a little bit. British aerospace group Rolls-Royce on Tuesday received backing from the UK government to build the country's first small modular nuclear reactors. The Rolls-Royce model reactor is like 470 megawatts. It's kind of pushing the threshold of what is a small modular reactor. It's much bigger than all of the other ones. The announcement follows a 2-year selection process and reaffirms Britain's embrace of nuclear power, particularly as it also pledged on Tuesday to invest £14.2 billion, it's about $19.2 billion, to build the large Sizewell C power station in eastern England. Now, the Sizewell C power station, that's a traditional big giant nuclear power plant. They're building 2 EPRs. That's the Areva European Pressurized Reactor Design, a more traditional power plant. So that is being built along with this first Rolls-Royce. UK Energy Secretary Ed Miliband said plans to build the country's first ever small modular reactors would create thousands of jobs, support regional economies, and strengthen energy security. We're ending the no nuclear status quo as part of our plan for change and are entering a golden age of nuclear with the biggest building program in a generation, Miliband said. I tell you guys, if anything good comes out of this ridiculous AI bubble, it is the fact that the world is taking a fresh look at nuclear power, which we should have done a long time ago. I'm glad this is happening. It's not a magic end-all, be-all solution to the energy crisis. Nuclear has its own challenges, namely, they're just getting so darn expensive and the regulatory burden is so heavy on nuclear power for good reason in some areas. But the fact that the world is taking a hard look at this instead of just pumping endless subsidies into renewables for another 20 years, that is encouraging. Maybe we actually get some power out of it this time. Rolls-Royce stock was up a little bit here. It's up about 0.2% this morning, $12.22 for Rolls-Royce stock. We're getting a little short on time, so let's just blow through these last few ones here, guys. Paramount cut 3% of its workforce as it deepens cost cutting. We're seeing a lot of this now, guys. The media companies are downsizing. There's a lot of spinoffs and mergers happening. I'll just scroll past here. Layoffs have been taking place across the media industry in recent weeks with reported headcount reductions at Disney and Warner Brothers Discovery. Yesterday, we talked about how Warner Brothers Discovery was splitting into 2 companies. We talked about Disney's layoffs last week. Now we've got Paramount going to that. The whole media industry is still recovering from this transition to streaming from traditional cable, and a lot of people are losing their jobs. Paramount stock down a fraction of a percent here, trading at $11.98. And the last one of the day, Japan to release 200,000 more tons of emergency rice to curb prices. The price of food in Japan just keeps on rising, and the Japanese are desperate to arrest this trend. Japan will release another 200,000 metric tons of rice from its emergency stockpile to tackle a doubling of prices since last year. Agricultural Minister Shinjiro Koizumi said on Tuesday, of the new release, 100,000 tons of the 2021 crop year rice will be sold first, and then the rest will be from the 2020 crop year. We want to continue responding without slowing down so that stockpiled rice can reach consumers quickly and at a low cost, Koizumi said. We must never allow the virtuous cycle of prices and wages in the Japanese economy as a whole to break down. If the cause lies with rice, then I believe we must address issues promptly. The virtuous cycle refers to that Keynesian magical unicorns and rainbows theory where inflation creates wage gains, creates more inflation, creates more wage gains, and we all suddenly become millionaires. And what the Keynesians always forget is because we do financial repression and we use things like immigration and money printing to suppress, or interest rates to suppress the demand for labor, the wage gains never keep pace with the cost of living. And so it's not really a virtuous cycle. It's really an endless cycle of financial repression, but I digress. Japan has so far released about 600,000 tons of rice from its roughly 900,000 ton emergency stockpile since March. That's most of it. What happens if they release another 300,000 tons of rice from their emergency stockpile? Well, if my calculations are correct, that means you no longer have an emergency stockpile. And you better hope the prices stop rising before that happens, because even with these releases of 600,000 tons of rice from their emergency stockpiles, look at this line in blue, what the price of rice has done over the last year, up 98.6%, virtually doubling just since last June. And that's with all this dumping of rice. They better hope it works. If it doesn't work and they run out of that strategic reserve, oh boy, there's your virtuous cycle of inflation visualized for you. And I just want to say thank you very much to Gordon Guano. Thank you, Gordon, for supporting the channel for 5 months. He says, time flies. Tell someone you love them. Abso-freaking-lutely. Good message from Gordon. By the way, I love you, Mini-Me. I hope you feel better soon. Thanks again, Gordon, for the good vibes and the support of the channel. Brojo says 1965 minimum wage was $1.25. Silver was $1.29 an ounce. Should minimum wage equal ounces? Keep on stacking, go miners, golden years, Gen X rules. All right, I'm going to ignore the little bit of generational rivalry going on there, although I am Gen X as well. So, yeah, I can get down with that. Well, you're referring there in 1965, the year after we went off of silver in our coinage. Now, I don't have the exact numbers, but if you look at what the silver value was adjusted for inflation in those coins, and then if you look today, what the silver value of pre-64 coinage is, it actually pretty closely resembles this $25 minimum wage that everybody's saying we should have, or the $20 minimum wage. Again, I don't know the number exactly. Please don't quote me on this. But the point is, the value of the silver in the coins has been steady if we still put silver in the coins, but we didn't do that. We took the silver out of the coins. Gresham's law, good money is chased out by bad money. And now we pay in bad money, and the value of the bad money has not kept pace with the cost of living because currency debasement is how we rob the masses in this country. Right? That's why I'm constantly railing against government deficits, because government deficits enabled by central bank money printing is one of the ways that we debase our currency, the primary mechanism by which we debase our currency. And then they manipulate interest rates when inflation gets high to prevent wages from rising. And so people lose their jobs and the wages never go up to keep up with the cost of living. Rinse, repeat over and over and over again. And you end up with an exploding wealth gap that we have in the United States. It's not because of tax policy. It's not because of the cause du jour that the partisan politicians are using to divide us. It's because they keep messing with the freaking money supply. That's why. Good stuff, Brojo, sir. Thank you for the good vibes and the support of the channel, sir. Richard Bell says 17 billion 30-year Thursday. That is referring to the 30-year Treasury auction that is coming up on Thursday. Yellen would love this one. Keep an eye on that. The 30-year Treasury, not the most liquid of assets in the bond market, and that is a pretty big issuance that we have coming up on Thursday. So, yeah, we'll keep an eye on that one. Watch what the 10-year yield does Thursday afternoon. If you see that starting to rise, it means something went wrong in that 30-year auction. Thank you, Richard, for supporting the channel, sir. Pigo's Trading Desk says, morning, handsome. Oh, shucks, Pigo, you're going to make me blush. Well, good morning right back at you, sir. Thank you so much for supporting the channel. And if I do say so myself, I can't help but agree with you. I am just so ruggedly handsome, right? Modest too. Thanks, Pigo, for supporting the channel. TK, been a member for 8 months. Thank you, sir, for supporting the channel. He says, petition to use pancake image for flat market days. All right, the pancake. I don't know, big pancake in the middle of it would have to be a stack of pancakes. I don't know, maybe a stack of pancakes. That's a little easier to tell what it is. Just a round cross section of a pancake might be difficult, but I don't know. I'm still leaning towards the platypus, man. And just like a duck-billed mammal with a flat head for days when the market isn't trading very well. But hey, I'm open to suggestions. Let me know in the comments. What should I do in the thumbnails for flat days, for days with low volatility? Thanks again, TK, for supporting the channel. Nashville Pasta Man says, this is the Chineseification of American IP. Yeah, I like the verb there. I like the verbiage, the Chineseification. That's pretty good. Where intellectual property theft, never heard of it. Like, yeah, I mean, look, you either have property rights if you're an artist, if you're a journalist, if you're an author, you either own your work or you don't. And if you don't own your work, guess what? We're not going to have any artists, and we're not going to have any journalists, and we're not going to have any authors because there ain't no money in it. And so if AI companies are allowed to just steal this information, monetize it without paying any royalties or asking any permission from the people who produce that work, then they are very rapidly going to run out of work to steal, which means the only art, the only music, the only literature we're going to have is this AI-generated slop, which you may have noticed is garbage. It sucks. And so, look, the judges overseeing this case, I'm sure there are efforts to influence their decisions going on behind the scenes. Oh my God, just try to imagine a world where the only art that is available is art that was created by some shitty chatbot somewhere in Silicon Valley. Good God. And just look what they did at some of the jokes that came out last year, like with the ethnically ambiguous Vikings. And come on, guys. Come on. We're better than this. Chinesefication. I like that, Pasta Man. Thank you, sir. 100 million melon coin to the man from Nashville. Thank you for supporting the channel, sir. And thank you, everybody, for having your coffee with the melon heads this morning. Don't forget that like button and subscribe button on the way out. I appreciate it for the algorithm. Thank you very much for the super chats, as well as you, my magnanimous melon heads on YouTube and Patreon. You guys rock. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.